Hi guys, can you hear me and can you see the screen? Good, good. Okay, so we'll begin in a few minutes when I see everyone in. Okay, guys, how's everybody's doing? Let me know if you hear me okay, and I'll start recording for the ones that aren't coming today, and we'll begin.
Yeah, well, it's good.
Okay, good. All right, so recording, and we're on. Okay, so just one thing, what screen are you seeing? You're seeing the presentation screen?
Sure.
Yeah, okay, good. All right, so today we're going to implement the theory that we learned and we constantly learning about the Quasimodo and the diamond, and see how we can incorporate all this theory and knowledge into trading, because in the few years that we're trying to lead the community of traders in RTM and the RTM Academy, we see a lot of people really struggling how to execute the plan. Okay, we all know how to analyze the levels very well, and I've seen your homework. I'll go over few points that I think should be mentioned, but most of us know how to recognize the Quasimodo, and the Quasimodo is a very basic tool. It's a very basic price action tool that hint us for a possible reversal or a possible good retracement that we can earn from. So let's talk about the Quasimodo. A few minutes before the class, I decided to do something that I wasn't planning. I want, and it's related to the homework that I see. The thing we're trying to teach you is some of you will look at it as if it's just a candlestick patterns. We're in RTM, we're not dealing about candlestick patterns, we're not dealing on candlesticks at all. We are talking about what price accomplished or did not accomplish. This is the language that we speak, this is what we read. Actually, if we look at the chart, we need to read from the chart, not lines and triangles and all these visual enhancers, we need to read the story, the narrative that plots these charts. So when we're reading, we try to tell the story of the participants of the market. So I will not go into details on that because this is something we really elaborate on the bigger course in the RTM Academy. But I want you to think and try to translate everything you see, everything you mark on the charts into the very primal theory of order flow. Okay, so I just want to present it to you. So while we try to discuss if this level is significant or not significant, that we will have a clue in understanding what's really going on behind the scene, and it will help us to decide what levels should be considered as significant. So this part is pretty much related to comments that I'm trying to tell you on your homework. So let me just get there. Okay, so here we have a Quasimodo, and this is the Quasimodo level. Now, the little practice that we're going to do now is we're going to look about the narrative of the Quasimodo in the term of order flow. Okay, so obviously we've checked this fake out level, and it's a bounce of something that we consider to be tradable. Okay, so it means for us that we have a buyer's power, and there's an order flow for the buying side from the buyer side on this tip. So this one obvious. But why is this Quasimodo level work every time, and most of the time when it worked very precisely? The answer for that is when you investigate what's going on in theory to the order flow. So let's go step by step on this zigzag thing. Okay, when a price bounce on anything, it creates it creates an imbalance of buyers. If it jumps up, if it jumps down, it creates imbalance for the sellers, right? This is the very basic theory of supply and demand. We're much more beyond this, but supply-demand is actually interpretation for order flow. Okay, so when a price turn, it's imbalance in order flow, right? So when it turns up, we have buyers imbalance. So now when price is going back and needs to win these buyers, because we know there's some order flow left, they need to inject much more power in order to bring price lower, okay, because they have to overcome these leftovers. So when they inject these orders, what they do, they actually create on this level, they create a seller's imbalance. Okay, so next time we come in here, we have selling imbalance, and we need to win it the very same way. That means that we need to inject much more buying power. Now this line is wired by buyers and not by sellers anymore. So once price come back again to this level, then we'll have the technical bounce because of the buying imbalance power of the order flow. Okay, so this is why Quasimodo work. Okay, and this tip, this engulf thing, is our hint that these buyers did something significant to price. This is the hint, but this is the wired line. Okay, so this is why Quasimodo or this left shoulder line work in favor for us, in this case, for buying. So I really want you to understand and try to read charts and trying to interpret what you're reading, not into lines and not to mark everything that you see. I want you to mark only the things that matters. So try to, okay, so now you have good visual skills. I've seen it in your homework, but now I want you to add more thinking about this. I want you to add more reading and try to narrate yourself the narrative of the order flow of what's going on beyond this visual, okay? It's a story there. It's a real market powers that work there, and this is what we need to read, okay? So this is my little comment about most of your homework. Another thing that I want to comment about your homework, and I want you to all pay attention for this. Some of you do, some of you don't, but any level that you mark, you must justify. You must reason and find the reason why this level works. If we have this fake out level and it turns here, we really have to go left and see if it's bounced, if it's a reaction of something significant, because we're going to have this formation of Quasimodo over and over in mid-range and in everything. Sometimes it's just a technical retracement, but we're looking for something with better probability than trading mid-range. Okay, so in that sense, we want to know that this tip happened because we're bounced at the technical level and not just because there's any type of impulse in the market that most of the time, we don't know why it happened, okay? So it's very important that every line, even the engulf line, and you need to justify it. The fake out need to be justified as a bounce. The engulf tip should be justified that it didn't hit target. This thing most of you do because it's more close to your eye, but sometimes the fake out is very far away and you really need to scroll left, okay? So that's the thing to, these are my main two comments about your work on the Quasimodo. The third one is that in this lesson, I want us to do things in a very simplistic way. Most of you try to draw almost everything you see. It's very good that you see things, but now let's try to analyze. Once we find a Quasimodo at the right location, now we should erase everything into blank page and just work on that and on the levels that may influence the scenarios that are going to happen next to our Quasimodo. Okay, so let's begin this lesson and see what I've prepared for you. So the objective for this lesson is to be mindful while we're trading. In our methodology, we have a lot of long waiting for the levels to come, and many of our traders, including myself and the people I trade with, suffer from the same thing. Sometimes it's really, really hard to wait for these levels, and we do all sort of things to to just overcome this long waiting. We will go to Facebook, read emails, write scripts, do all kind of things, go on debates.
PlayStation, maybe.
Yeah, start talking in the chat room. Go to different time frame and different instruments to analyze, and then boom, when we back, we missed our trade. Okay, so the thing is how we keep while we're waiting, and sometimes it's very long time waiting, how we keep being mindful and in the zone, concentrated and focused for until price do us a favor and go there and we start doing our work. The other thing is we want to be all the time looking at what the market show us and read like a blank page. We want to have the objective of seeing everything, the good, the bad, the worst, and so we can really not be affected by our historical thoughts and be more professional when we're approaching our trading day. To do so, what we're going to do, how we're going to occupy our time, is that by trying to think, because we now know price action pretty well, we want to try to think what will happen when price will hit the level that we think we want to trade. And many things can happen because we don't really know what will happen. First of all, we can have our wishful thoughts, and the trade will be great, but then it can also turn out to be a very bad trade. But the gray zone is that sometimes it's not a good and not bad. We cannot determine what's going on. We have like three options, three kind of scenarios that we need to think about, and once we have them, once we plotted them with a price action prediction, and I'll show you that in the end of this lesson, we want to create a plan for what we're going to do on each case. Okay, so if we are going to be prepared for anything that is going to happen, and we'll be well prepared, and we see things align with our three scenarios or even more, then we can execute instantly whatever we planned before. Okay, so that's what we're going to do. So first of all, we need to understand that what is our role in the market. Maybe I'll say basic stuff, but I think these things need to be mentioned over and over, and even professional people always need to remind themselves the very basics. So we'll go over this very quickly. If you have questions, just let me know. Okay, the first work assumption is that we don't have any influence about the market. So we may read right, and we think we understand the market, but many things can happen in the market. And whatever we do, we do not influence. It's really not usual work in that sense, because in most work that human beings are doing, they come to work and they influence their environment in the social way, in the professional way. In many ways, we influence the environment setup and the business setup that we are in the financial market, and in such big financial like the Forex. We have no influence whatsoever, so we're little fish, and we need to, and because of that, we need to be open to all consequences. Okay, so whatever market will do, we need to have a plan for it. So the other thing is that we are very limited in predicting the market bias or volatility. Probably it happened to most of you, if not all of you, that you were predicting the market right, but volatility killed your trade. Okay, the range of the volatility was too high. You got your stops, or it scared you, or your hard stop hit anything, and then it went your way, and it was very frustrating. This is something that we cannot really predict. Okay, so we need to be prepared for that as well. So I'll just give you a hint. If we got our stop loss hit because of unexpected volatility, we should be happy about this because it's our plan. It's going to save us for the long run portfolio making, and so we lost on that trade, but we cannot predict or control volatility. The other way is not to work with stops, and it can grow up to very big losses. So we should be happy, even though surprisingly volatility hit us. We should be happy about this. So and another thing I was telling If the other day, a week ago, I was talking to a pro trader, and 10 years ago he used to work for a very big financial company, and one big client of him asked to hedge $60 million worth of yen, and they wanted to do it very quick. So they couldn't inject orders in a smart way, so they just inject the $60 million worth of yen orders into the market and move the market 50 pips. Okay, and he was telling me this as a joke. He was telling me that the next day he opened the newspapers and read all these analysts saying that these 50 pips were caused by the Bank of Japan intervention, or because it hit the moving average of 144, and because it hit this and that, and all kind of mambo jumbo. And he knows the truth. He knows that it was just an impulsive decision of some participant in the market that caused this big move, and it was unexplained. So these things happen all the time. We don't know who's impulsive now, who needs to hedge 60 million at this point, and it can ruin our plan. Okay, but if we're well prepared and we manage risk properly, then when these things happen, we need to acknowledge and be aware that these things happen, and it's part of the game. Okay, so let's go to the positive part. The things that we can control are when we enter, when we exit, or when we sit on the fence. And these decisions should be very wise, because unlike many other jobs on this planet, in the market, you decide, and nobody will force you to rethink this if you enter the market, exit, or you sit on the side. You are really transparent to everyone. So it's our decision, and this decision will never have a feedback from anyone for good and for bad. So, but this is something that we control, and we need to really adopt tools to so we will have a benchmark to know that we've done correct. Okay. And we have a good, reliable reading methodology, which is the price action that we constantly are learning. And of course, we will have to adopt real money management and risk management tools. Okay, so now we take the Quasimodo and we need to break it down to a plan. How we're going to trade it and what we're going to do with it. First, we want to scan, to see the right things, and then and once we see it, we want to create our plan. So for this thing, I took a Quasimodo we found Friday, and I brought it to the discussion with you. And I want to show it how it's look on real time, because now we're really investigating history, but from now on we're going to start working in real time, meaning the Quasimodo is not resolved, and it's going to look very different. So let's just discuss about the anatomy. We talked about this. I was thinking it's worth mentioning to go over the anatomy again, because I've seen your homework and I want you to focus only on the Quasimodo itself, and I want to speak on each point separately.
First, one second, Gil. I'm sorry to interrupt you. I would like everybody to take a moment and look at that chart and just imagine what's going to happen next. Just give Gil 20 seconds to get his voice back together and have a drink of something, and just think about what's going to happen next with that. Yeah, and that's it. Whenever you're ready to go, Gil. Sorry for disturbing.
Okay. May I?
I think you should.
Okay, good. So, first, where the fake-out level is, I call it fake-out because it can be higher high or lower low, and so the fake-out level should be always, and I really emphasize this in bold letters, always be justified. Meaning we always must go left on this tip. Do you see my mouse there?
Perfectly.
Yeah, okay. We really always must know what is this reaction. Must, okay? Always we have to go left and see if this a bounce of something significant. And the easiest way to determine significance is extremes. If you all remember your first lesson in supply demand, we were talking about drop-based rally and rally-based drop, RBD, DBR, right? These are the extremes. I mean, we're looking there. We don't look at the flag at the mid-range. We don't look, when you be more experienced, maybe you can take risk there. But for now, we're looking for a very reasoned place for price to turn. And I tell you why. Because when you're trading mid-range levels, we don't know, price can go anywhere, because the bigger order are at the extremes, at the top and at the bottom. Okay, so and the bigger targets of the institutional players are there. So everything goes in between can be very impulsive. So sometimes mid-level works and sometimes they don't. We shouldn't be very impressed when these mid-level work. Okay, so that's one thing. The other thing, which is much more important, is the potential that we have for each for these trades. Meaning that if we trade the extremes and the extreme is justified to take short on this case, let's say, the potential, the risk-reward potential that we have here is much bigger. Okay, much bigger. I mean, by hundreds. Okay, so and the success experience that you get out of the market is much bigger, and it really contributes your confidence in trading, which is a very big issue for any trader. Okay, so we're looking to justify this level. If this is not a bounce, if this is not a reaction of something significant, a higher time frame or extreme of the same time frame, then just forget it. Don't trade it. It's good for practice, but don't trade it. Okay? So that's the fake out. We really must justify it. Okay? So in this case, you see this yellow line. The yellow line goes to the extreme of this compressed area. Okay? And it's really in terms of order flow, we have this decision point, and this is may be a good place to give at least something. Okay, so this is the fake out level. The next thing is the Quasimodo level. It's the left shoulder. Okay, we determine this by the retracement and that after that retracement was resolved, it was resulted by the fake outs, okay, by a higher high. Okay, it's because if you remember the first part of this lesson, I explained why these order flow happen here and here, how they flipped into buyers and sellers and vice versa. Okay, so this is the level that we want to work on. Anyone that participated with me last Friday on the discussion in Skype know that there's a little trick in here. So you'll have time to rethink about this, and we'll talk about this at the end of the lesson if we will have time. Okay, so then we have the left shoulder, and there's not a lot to discuss about the left shoulder. Most of you
Gil?
do it right, yeah?
There's one question that came up in the text there, which I'd like to just answer in words, and it is, let me see, where's my mouse? The question is, well,
extreme in another.
Yeah, well, mid-range in a time frame can be extreme in another, isn't it? Absolutely right. You can be in between a lower flag limit and an upper flag limit heading up, and it can bounce in the middle of nowhere because there is a much smaller time frame flag limit in there, which is causing it to bounce. And in that lower time frame, you can trade your PA all you like. Just do not expect a massive reversal from such a thing, because it does have its target in the upper flag limit, and it's going to go there. So that is that. Of course, it's the opposite for going down. We shouldn't just be like me and always selling. We should be thinking of buying as well. So yeah, that's it. Sorry to disturb.
Okay. Yeah. Okay, so now we have the engulf. Again, the engulf should be justified, and once we engulf, we really need to investigate and understand why did price stop retracement at one point. Okay, so on this engulf we have the first one, also the second one, and on the third flag limit, it bounced. Okay, is it target? Is it not a target? What is it? Is it supporting to go much higher or not? So this we need to discuss all the time and explain ourselves if we want to trade it. If this is going to disqualify the whole QM, the engulf really can just disqualify the whole setup. Okay, so I will tell you my opinion on this. when we have this base that is bounced, but it's not the extreme. You see here we have, oops, let me go back. You see here we have another little Quasimodo level, and here we have this some clean order flow here. This is the extreme target. So I imagine that if price will bounce here, it's really not getting to the final target. It is target, and it can also play it out to be a good buyers, but we don't know this for sure. But we have more probability for this area to be the one that will initiate the move to go up. So in my opinion, this is not target, but it's questionable. Okay, I will not be very definite about this. Another thing I want you to mention, and because it's always going to be the debate. It's always going to be on the discussion if this is a real target or not. So what I have to tell you about this is that you know that price goes, and when we investigate price on a lower time frame, and sometimes we go even to tick charts, price is always zigzag. If we see it, we know it, it's obvious. So this is a very legitimate place to get a little bounce from. Okay, so we've seen a little bounce at the beginning, and then it's going penetrate everything. So it's really consumed the area here, and this area can really hold it because it's pretty close to the low, but it's still debatable. We still can question if this level can be considered as targets. So price really, because price move in retracements all the time in zigzags, this is a very legitimate way of price to react to this area, right? Okay, because we see here decision, we have this order flow, but it's not as significant as this area. Okay, so this is the final target. If price wouldn't go here, this would absolutely disqualify RQM. This one, just leave it questionable. Okay, so we will discuss this, how we're going to trade this specific conclusion later on. Okay. Next thing we need to understand, once we have this, we have the three lines, the four lines of the Quasimodo. Now we have to always be in tune of how the approach is going on. There's many ways that can happen, many things that can happen along the way, and we need to really investigate this. This is the part that I mentioned at the beginning, that we're starting to be very mindful to our chart. Always look what's developed in this area. So obviously, if price goes on a really nice compression to that level, it's super, and then we can trade it. But it doesn't mean that if we concluded it's a QM, we're not just automatically place a limit order here and wait to see what's going on. We really need to know how price is building up toward this trade level. Okay, so it's very important to discuss. Okay, so eventually what's happened is price was going up on a very legitimate place. It bounced down. It went all the way down, took all the compression took the little orders from here, almost a small, it didn't really took it as a Quasimodo, but it took the lower orders here, and then it climbed up, and now it's in our level. Okay, so in this level, we can decide what we want to do. We have about two options here. We can trade it in a touch trade, meaning once this price hits this line, then we're in a trade. But we can also look for a confirmation. And what would be a confirmation? A confirmation would be exactly what we're doing. It's going to be a little Quasimodo in a lower or very lower time frame, 1 minute, 5 minutes, a tick chart. If we see a Quasimodo forming on this very exact level, then this would be our PA confirmation to take a short on this one. Okay, so so this is the approach, and this is how we enter. So now, because of this approach, we need to remember when a few slides ago, before we had the approach, we had our Quasimodo, and this is was actually the target. This is one target, and this is the final target for this Quasimodo, and maybe it can turn out to be a swing and go all the way down or even more. We should just check it on the higher scales. But once we have the approach, now we have new PA to consider to define our target. So now when we enter the trade, only now when price completed the QM, we can define the risk for the trade, meaning we know where our stop should be, where our hard stop should be, but now we have new target zones for price to come, because we have new price action that formed on the way. Okay, so now these lines are new targets for immediate price. So if you want to take the lower hanging fruits, the first initial reaction of this bounce and be safe, it's going to be between these two lines. It's just I did it very rough. Okay, I didn't really go in deep there, but these are this is the initial target for price, and this one should be resolved as engulfed in order for us to think lower targets. Okay, so this is why the approach is very, very important. Okay, and also the reaction itself, it creates a price action, and what happened inside this price action should be considered if we want to hold the trade, yes or no, if you want to take some out, if we want to go break even. Anything should be considered while the trade evolves. Okay, so these are the targets. A new term I bring up is what I call a fail level. Fail level is not necessarily where you put your stops. What I mean here is I want tell you what is how I determine fail level in terms of price action. I want each one of you to think what should happen above this line. If we were saying that we're going to sell this line, what should happen above this line that will hint me that I need to leave the trade, close it in a loss or in a break even before it hits our hard stop loss. Okay, so if you put this into your equation, then you will have more tires of security for your funds, for your money, because you will have, this will be considered the mental stop of the trade. Okay, you need to really define what is the PA and the level, and the PA played out on the levels that above this line that will tell you that this is not your trade. Okay? So this is the anatomy of the Quasimodo. This is all the things that we are considering once we want to trade it. Okay? Very important is the level of the fake out, very important the engulf, and then all the rest, all the comments that we've said. Amos, do you want to ask a question? Let's,
yes.
yeah.
Can I show you on the chart?
You want to draw on the chart? Let me see how I can do it.
I think he wants to show a chart. If you have, if you've downloaded the software.
I can show you on this chart.
Oh, okay, okay.
Let me see how I do it.
I think it's okay if you just will see my mouse.
Yeah, let me see. Give keyboard and mouse.
There we go.
Go ahead.
Can you see?
Yeah.
Okay, let's say this is a monthly chart. And this is our QM level. We already know all these things. You check into the lower time frame for PA there. But as Yves told us in the first webinar, this is an ignored Quasimodo.
True.
Which can turn into our target.
But it's not a Quasimodo, because look at the thing go.
Oh no, but it is a left shoulder level, and I am happy to have that as a target.
Okay.
Because price should have respected that, and it should have at least come back to the two highs below.
But engulf hits target, so it's not really. Okay, go ahead.
Okay, thank you.
Oh, so that's
okay. Gotcha.
Okay. All right. Okay, so let's move on. Let's see.
Oh, if we're about to move past the fail level, I'd just like to say one thing about it. But if you've still got more to say, it might be in there. Okay. For me, the fail level is, okay, may I just have, can I give myself thingy a second, request keyboard and mouse control. Okay. Alrighty. For me, if I'm going to take this Quasimodo trade, I know that there is also the possibility that there's a set of orders in there at the very high, and I also know that there is a possibility that if this high did not get to the MPL of the actual level we're reacting from, I could be looking at a diamond. We could be going up higher than that to the last set of orders. Now, for me, if I take the trade here, I am taking a Quasimodo trade, and that's it. That's all I'm taking. I'm not taking a higher time frame trade here at all. It's just this Quasimodo. And for me, this is the kink that ties in with the left shoulder. And if this breaks, then my Quasimodo trade is gone, and I've got to look for further PA to get in on the trade. So with me, once this is broken, if price gets back up to there, then my Quasimodo trade is gone, and once price bounces back down to these highs, I'm going to start thinking of getting out, because there is no point in rationalizing and saying that, okay, this Quasimodo has failed, and there's no PA down here, or no really clear PA down here, so right, I'm going to wait for a nearly double top scenario, try and find PA there for another entry, or wait for the if I don't get the PA there, I'll wait for the diamond level above. I'm flat now, but if I get PA at the diamond level above, then I will get in. So for me, if you're taking a Quasimodo trade, if it's not absolutely certain, then the Quasimodo, once it breaks, once the kink breaks, that's failed. It's not a Quasimodo. Then it can be a double top trade, and if that fails, then wait till it retraces and get out a profit. You're bound to get out a profit at this, and then wait for the diamond trade. So there is 1 trade opportunity, 2 trade opportunities, and 3 trade opportunities. There's no point in letting this one drag on much higher and put you in deep drawdown to bring you to the next place, which may or may not work, or to bring you up to the diamond level, which may or may not work. So for me, a failed trade is absolutely, definitely above the kink of this. There's no point in having a stop loss there because price will undoubtedly bounce back to your entry anyway. So that's all I have to say on that. Thank you.
Okay, thank you. Okay. Okay, so when we work on this level, we want to classify our QM, and we always want to. Oh, you're still holding the keyboard? Okay. Okay, so we need, so we want to ask all the question about, is this Quasimodo is qualified? We want to qualify or disqualify it because we don't want to get into the wrong trade, right? So we really need to ask ourselves sincere questions and be as much as objective about what we see and not about what we want to see. Okay, so let's discuss, even though it's looked very obvious. I've learned over the years that sometimes obvious things are really things that we forget to think about them. So so this is why I'll spend your time on this. But it's obvious, but very, very important. We really need to ask ourselves the very basic question: is this Quasimodo qualified or not? And so we're going to ask. We're going to first investigate the fake out. Is the fake out on the right level? Like, is it bouncing on something that is significant, or not? If yes, then we can move on to the engulf. Is the engulf really engulf something the interesting flag limits that we wanted? Is it not hitting the target? So we can qualify this trade. And also, once we got the setup, it's still not the end of it. The approach to the level is really important, and many times when we trade in real time the Quasimodo level, we forget to mention this, because most of the time when we study Quasimodo, we talk about the history, and most of the time we look at formation that did work out because it's easier to spot in the eye. So we're not really discussing the approach, but in real time, when this setup evolves before it gets to the level, we really have to pay attention to the approach. So what
especially,
I did...
Absolutely, especially if there's any doubt that that it is a perfect Quasimodo. Absolutely.
Right.
If you haven't got a very clear engulf that didn't hit its target, then the approach on the retrace is vital.
Yeah. So so in the next slide, don't copy it for me. Don't tell anyone that I told you this. But this is how I do things. Okay? It's just it's not a system that I pass you on like this is it, but each one of you really need to create this this type of classification of what would classify the Quasimodo as qualified or not. How do you want to trade it? Okay, so I'll just give you examples in this table. I have three statuses for each one of these three dimensions of the Quasimodo. One is a touch trade, meaning it's so obvious that it should work that I can really put a limit order and just go to sleep and wait for the outcome. The other one is that I want to wait for price to come to the price, and then I want to look for another confirmation, a lower time frame confirmation. And the next thing is what will disqualify the whole the QM. Okay, so I want all three or four elements of the formation to be at least on these first two, and not to be on the abort status. Okay, so I'll just give you an example. For me, if the fake out is a reaction to first time retracement plays, if it's on the extreme of a real RBD, DBR, if it's a really clean order flow place, then I really like it. I give it the best grade. Okay, so let's see in this situation, we see price retrace, fake out, and then in this area you see it's really consumed some of the order. So there's no clean order flow in here. So it's not really a touch trade, but it still may work because we've seen the outcome. The outcome is engulfing, not hitting target, real target, and so so the Quasimodo is at good level, but it's not. But it's still questionable. So we need to go for a PA confirmation once price hits this level. Okay, so this is the way I think. For a PA confirmation, I would if this Quasimodo formed on midway flag limits or support resistance lines, or it's out of a very high time frame.
I do like that little set of orders that's in there, by the way, Gil.
Sorry?
I do like the set of orders that's in there. I wonder, do I still have control? This here, now this is just me being overly technical, and I'm sorry about that. We do have our left shoulder here. We do have another left shoulder here, and then we have this spike and this spike here, the two candles beside each other. When this came down and engulfed that, it came and retraced. It should have retraced all the way up to here, to just before that little compression, but it didn't. It came up short of it. So those orders for me are still there, and this is M30. So I'd be very confident that in there is a nice little set of orders. You could even place it right here at this candle that's before it. It all ties in. So for me, the orders are there. Just want to clarify that. Thanks.
Yeah. It's actually I was saving it to the last, and but.
Ah, okay, sorry.
But yeah, here this is the level that really was precise on this, and it's let's say it's a M5 or even M1 Quasimodo bouncing off this level. Okay, so we have this, or so we justify this little QM. It's right here, okay, and then it's come back to here. So this Quasimodo is justified because of this level. Okay, so
Yeah. And Scooby says small QM on big QM level for confirmation.
right.
That's just the most beautiful thing in the world, Scoob. That is just, oh, it's fabulous.
Yeah. So that's the perfect laboratory situation we like.
Yeah.
Okay. So so we have how we qualify the fake out, how we qualify the engulf. We write our rules of what will be the best things to happen, and we classify how we're going to approach a trade when we have these situations. So I suggest each one of you will write yourself something like this. I'm not really, it's not mandatory that you do it in the very same formation, but for the sake of the classroom, maybe you should do it. If you think you have a better system of writing these things, then do so, but you should tune your mind to what you want to look for, and always do the constant justification and the qualification process for your QM. Okay?
Just a question regarding the this chart. Let's say you would have an engulf right there after the last target. Is this QM level valid after that? Let's say you would have an engulf below this into a higher scale. Would be this valid or short?
Yeah.
There are a few variables on that. It really depends on where the very high on our chart is. If it is just at the edge of a much larger zone and the bottom of the chart is on a much larger zone, you can retrace very, very deeply into the upper zone before you can come down to the lower zone. You're looking at really higher time frame stuff. So, yes. I think that's the answer to the question.
Mm-hmm. Thank you very much.
And one thing I want to tell you is that I've learned that Quasimodo, by the way, it's my favorite price action thing, but Quasimodo has a very, very good memory. It's like an elephant. It can,
Absolutely.
I think 2 years ago, I had a trade where I used the Quasimodo level of I think it was something on a yen. I don't remember which one against the yen, but I used something from the 80s of the last century because price just went to these levels, and I used something from a very, very far away.
Yeah.
And it's just amazing.
It makes you smile to do that.
Price really snapped to these points because of order flow, because it's because something is waiting there.
And it's also
the reasoning.
It's also, I'm sorry to disturb again. I hope you don't mind me disturbing you so much. It's also because the people who are moving price around, they're acting on instructions from somebody else. Somebody is going to say to them, okay, before we bring out this news in January or whatever it is, we're going to bring price up to, and they've got this whole history chart there, and they're going to say, we're going to bring it to, and they put the finger at it, there, that's where we're going to bring it to. And they will always point at something. And they don't just say, okay, bring it up to the middle of blah, blah, blah. It's not like spinning a globe and putting your finger on it. They're actually looking at the chart and they'll say, bring it to there. And that's it. Their finger says they're going to bring it to there. And that's what their employees do. They bring it to there. So, yeah, sorry, that's it.
Okay. So the conclusion is Quasimodo and order flow price action analysis has a very long memory because these places are very logical. They are wired and tuned for these for new orders. It just places, it just pulls, needs water to fill in. So it's really
right.
something. It's like the physics of this economic environment. So
Yeah, and one other thing is, I'm so sorry. Another thing as well, it's just about the manipulation of the market, and the ITs, they have to make the market look like there is some sense to it. Otherwise, nobody would get involved with gambling in it. You have to give people a reason to think that they have a chance of winning in this market. So they do put symmetry into the market to make you try or to make you think that you can work it out. And they bring you very close to being able to work it out, but there's a lot of misinformation out there. There's a lot of propaganda which gets you just short of the truth, just short of it, short enough to get you in at nearly the right price, but put your stop loss in the wrong place so that they can bring price to your stop loss and turn it around. And you see it all the time. Everybody who has learned to trade and has gotten any good at trading remembers those times when they stopped out and price turned exactly there. So yes, yeah, carry on, Gil. Sorry, thank you.
Okay. Scooby is asking or saying that small QM on big QM level for confirmation. If that's a question, then yes. If that's a statement, then yes. So, okay, let's move on. So now we have our mentality of always judging our setup if it's qualified or not. And while we do it, and while we prepare for a trade,
Sorry,
sorry?
I took controls again.
No problem. So while we are waiting for a trade, another thing that is very important to keep us occupied with is plotting scenarios. Like we mentioned at the beginning, anything can happen. I mean, of course, we have a good way for predicting that this may work, and we have all the reasoning, and we investigate it, but things can go wrong. Things can go wrong because many things. Maybe we missed out some elements in our analysis, but also we don't know if nobody is very impulsive now to hedge 60 million at this point, and it just can just wash out these levels like there's nothing there. Okay, so when we're speaking about this level, we're talking about normal conditions. So if price will go and the zigzag will be in that range, but when the markets get excited for many reasons, sometimes these reasons are events that we know their time they're going to show up. Sometimes we don't. Sometimes it's just somebody very impulsive at 2 a.m. in the morning doing something. So and it just wash out the level, even though this level is wired with waiting orders to fill in. But he washed out the market so much, this level will just not be reflected. So we need to be prepared for everything. And it's like you driving your car and you're wearing your seatbelt, but for years you didn't have any accident. Okay, so you have your safety belts and you have your air cushions and you have everything, but you're not using it. Okay, we need to prepare for everything. So the next drill that we're going to do is plotting scenarios. And how we're going to plot scenarios? By our understanding of how price move. We know price move from level to level. I imagine the order flow by these SR levels, meaning that let me try to draw it. Price will bounce from here, maybe will go and bounce from this line. It can go down here, and go up. Because this is consumed, it can maybe just bounce on the tip, go up and go to the next level, bounce on that stop and go to that level, and so on. So we can create all kinds of scenarios according to our understanding of price action. So now we're going to need to create as many scenarios so we can be prepared. So let's talk about the good scenario, which is price will bounce from here and will do whatever it does, and then it gets to our level, and then everything is just super positive, and price just drop out very well. Okay, so that's would be one scenario, and we should think, what do we want to do here? This is what will tell us that things are going wonderful to our trades. We need to say, okay, here if we see a very fast reaction and it needs to really fast engulf this price action, then we know we're on a safe mode. Okay, so, and if it's not happening, if it's really bouncing here and compressing and going very slow, it's a different scenario. Many things can happen here. Okay, so as much as you prepare and plot the events that may occur on that level, and then also you must write what you're going to do on this. Are you going to wait? Are you going to close to scale out? Are you going to, whatever you plan to do, you must have it, because once you have these plans ready with your action, then when it's happened, boom, you have a plan to do. You know what to do, and you don't need to rethink things. Okay, so another case that can happen is price bouncing off, and it just compressing and jiggling and not deciding and just going off the level a little bit and go down, and this is a really these are the most scenarios that will happen to you. Okay, I probably think most of you experienced this. Most of the time we have the orange scenarios happening like this. The reaction is not that fast, it's not decisive, it's just climbing up a little bit more than we wanted, but because it's slow, we're keeping it and then giving it some chance to go. What are we going to do when price penetrates our risk zone and in a very slow way? I mean, if it was fast, we would know we don't want it. But if it goes slow in compression, we always say, okay, it's compressing, maybe it's going to bounce on that level. And because it's compressing, it's a good sign. Let's keep it wishful thinking and wait for the miracle to bounce back. We need to be prepared for these specific scenarios. The not so good and not so bad scenarios, they are the most complicated to handle. So if you plot these and write yourself what you're going to do on these events, then you'll have easier decision-making process how to handle this. Okay, and even if you say that you in this price level you want to go out and still turn out to be a good trade without you, then you should be happy because you were sticking to the plan, and sticking to the plan is very, very good. It's super for your success in this business. So when you take the loss is part of the game. And if it's not something that is obvious a winner or obvious loser, maybe we should be out. It depends on your personality. It depends on the risk and the size of the trade itself. So you can decide, but don't let this event when this event happen, only then to start thinking what you're going to do. When you're here, before this happen, have a plan for what doing here. Are you waiting for a diamond? Are you going to go out? Are you going to scale out your trade a little? What you're going to do? Are you going to wait for break-even and then leave at break-even? You can do lots of things. Try to think what you're going to do if that happened, and most of the time it happened, okay? And then, of course, we have the worst-case scenario, and it's very obvious. Try to think here what price action tells you and at what levels beyond this line, okay? Because, of course, there's this line and this line and this line, and here maybe on little time frame that price can retrace back in your favor, okay? But so you need to determine these lines and tell yourself what price action I don't want to see, and if that happen, I'm going to do what? Leave partially, whatever. This is the methodology that will keep you on an ongoing busy while you're waiting for the trade. And when you're in the trade, it's going to keep you busy always to reassess and always to rethink according to what happened in the price action. And you can modify your scenarios accordingly and create more action plans and be ready for anything that's going to happen. And so when you see something that is definite for each one of the three scenarios or even more, then you can execute it most immediately, and then you clap yourself on the shoulder and you're happy whatever the outcome was. If it was a loss or a win, you should be happy, okay, as long as you did it right. Okay, so you write your action plan according to all these scenarios, and this is the outcome that turns out to be on this situation. So that's about this class. So what we want you to do this week is, beside practicing more identifying events, but now we want you to identify Quasimodos first at the right level, where you can qualify or disqualify the location of this formation. I want you, because it's a drill and you have to practice it, I want you to write your justifications for qualifying or disqualify your Quasimodo, because now it's not just finding the formation, it's finding the formation that we want to trade, okay? Because Quasimodo are all over. You can find them all over, but we want to find them in the right place, right? So I want you to be very much aware and explanatory and reasoning for how you classify, how you qualify your trade. So I want you to find, like we did in slides number 1, sorry, this one, I want us to find events in real time where the Quasimodo is not resolved yet. We're having a level that we thinking that we want to trade, and do the whole process that we're talking about in this class, and go over. So I want you to give reasons for the qualification. I want you to learn whatever goes in lower time frame to see if you can fine tweak the level for your entry. If you're going to real trade it or demo trade it, don't forget to leave some space for the spread. Sometimes you really need to, but for this, but try to be as much as precise on the level on the be a pip precise on the level. And if you leave some room for spread, just mention that so we know it's not part of your analysis. Okay.
Oh, I remember somebody in the homework put down to allow for spread on at the top for a take profit after a buy. Well, you don't have to allow for spread on a take profit or a stop loss for a buy because you're always going to be paying that little bit extra for any trade that you take. So if you're buying, you'll always be buying at the higher price, which is the ask, and if you're selling, you'll always be selling at the lower price, which is the bid. Yeah, thank you.
Okay, and if you work with MetaTrader, I think they're based on ask. I think no, they're based on bid. Yeah.
Well, no, buys are based on ask and sells are based on bid.
No, not the trades, the charts, the price.
Oh, the charts. Oh, okay, yeah. Well, if you only have the one line, then yes, it is bid, certainly. But our what's it called? The candles themselves are all drawn on bid. Yeah.
Right. Okay. So the next part of the drill is once you find your formation and you qualified it, then draw your possible outcomes, and do it by imagining the possible price action scenario, how things will happen. Try to find as many as you can, but make it reasonable. I mean, don't just overdo, but try to find the ones that goes very good, the ones that goes very bad, and the ones that in between, and explain yourself what you're going to do when anything happens. Okay, so that would be your last part. It's the trade plan. Okay, and once you have the trade plan, then describe where is your entry, where is your first target. If you use more than second target, describe it. What you're going to do when your first target hits with your hard stops. Where is your hard stop? Where is your where is your safety level? That the stop mentality level. What should happen there to exit manually? Everything that we've discussed in this lesson, if you incorporate it into your work, it's going to be very helpful for you to create your working plan and be fully minded while you trade. So this is the mentality we look for when we're trading. So this is it for me. If you have questions, I'll be happy to hear. If not,
While people are formulating questions, if they have any, I'd like to say one thing, well, a couple of things. Thank you very much, Gil. I have learned a lot from this myself. You've done really well. Another thing is that once the last lesson is over after next week, I'm going to set you guys one piece of homework. I won't be marking your homework, but I would like everybody to do this one particular piece of homework, and even once you've done it individually, discuss it together and try and make it perfect. I will ask each of you to try and learn as I learned. Now, everybody doesn't learn the same way, but what I found was the best tool in the universe for learning was to actually try and explain it. It wasn't all information coming in. I learned far more by putting the information out. So, you know, the learn by teaching thing. So after this course is finished, I will want everybody simply to write a thesis on how or what they've learned about the Quasimodo and about the diamond and what they know about it. Because for so many people, learning by teaching is the very, very best way. So yeah, that's it. If there are any questions, Gil and I welcome them.
Yeah. All right, guys. So thank you, and try to submit your work, and we'll see you in the forum. And this week we'll announce about the third lesson, which will be more doing things in real time. I think we're going to take some Forex tester events, and we see how things evolve. We see how we elaborate on the things that we've talked today, how we discuss the mentality that we need while we're trading, how we always reassessing the situation while we're waiting for the trade and while we're in the trade, and all the scenarios that can happen, and the action plan. So we're going to do it hopefully live. So if you guys see on historical level, although I don't want you to deal with this history this week, I want you to deal with real-time events, emerging formations. But if you know of something interesting, something that didn't work, something that worked, something you didn't in the past that you think you deal good or bad, and we want to simulate this on Forex Tester live event, then tell me. If not, we'll find the event and we'll discuss them as we go. So this is the plan for the last lesson.
Just a question, if you don't mind. Can you put your first chart, I think, from this presentation?
The first chart. This one?
This one, exactly, this one. Just a hint for us where to find our level. Let's say in higher time, this is a higher time frame, let's say. This is a flag limit. This one. We would like to take a short with Quasimodo in M1 at this MPL.
Okay.
According to what we see there, where will be our final target? I mean,
this is pretty hypothetical now, isn't it? I think it's pretty hypothetical. Really,
can I
looking
answer?
at it, yeah, go on.
First thing, this area is very wrong to my opinion, because it's mid-range, and in mid-range, any impulse can happen. So
yes, but
probability-wise, it's wrong.
Monthly chart.
That's the monthly. Let's say they're looking for an H4 there. You're going to get H4PA there. Yeah.
Yeah. So okay. So if you go, so if it's a very high time frame, you drill down to a lower time frame and see what price action will be there, and also the target will be based on the time frame that you work. So let's say you see formation on H1 and your entry will be on M5. Your first levels to investigate to see on the target will be on the M5, and if that gets engulfed, you go to M15 and M30 and M1, and maybe it's going to evolve to H4 or even a monthly trade. But you start from the very, very small time frame where you have the very accurate price action to work on, because when you work on a monthly level, and it's something I was planning to say, but because one, I think, If was saying something, I forgot to mention it, but it's
Sorry.
when no, it's okay. When you are taking very high time frame levels, you can't take them as is. Okay,
True.
you really
You have
have
to
to
take
go.
beyond that time frame.
You really have to go to at least M15 or even lower if you have the history to see what was going on there, and most of the trades and most of our setups, if you want to be as much as accurate on the market, you should go all the way to 1 minute charts if you have the data.
Yeah.
Okay, but even if you plan to work on a monthly level, okay, because a monthly level has so much a very big range the things that can happen there, and so you really need to go to a working resolution, which will be something in the intraday charts. So
There,
even
there, there is one thing that I would like to say about it. You just finish and then let me in.
I'm done. I'm done. It's
Okay, okay. Let me see. I believe I still have controls. I do. Just to the specific question you asked, let's say, oh, come here. Don't nobody move your mouse for a second, please. Let's say you're working from this level, and this is the monthly. You've got your little kink somewhere over here, and you want to look into the lower time frames. You're going to say to yourself, okay, in the monthly time frame that we've got here, we've got that level, and we've got its kink. So what space do I really want to fill with this? Then you say, okay, well, I'm going to have to look left on this and or left of where price is right now, and see what I've got. So you will go over here and you say, okay, this high is behind it, so that's not where I'm looking to bounce down to. This is below it. Maybe I'm looking for this to bounce to. This over here, is this the first thing that we're going to find? You're going to look for the first highs and lows, and they are going to be the obvious places to look. So in this case, what's the nearest thing? The nearest thing is what's very often the nearest thing is these highs over here. That's the closest thing you've got, and it looks like history lining up with it over here as well. So you say, okay, I'm going to try and take a trade from this monthly flag limit over here. In the monthly, what space am I looking to fill up? Well, I'm looking to fill up the space between this flag limit and where this guy was broken. So you'll find the kink on the break of that. And that is the space that you're going to try and fill up. And you can, it so often happens that you might not even see in the time frame you're watching, you might not even see that bounce happen, but so often that space is going to fill up. You're going to form a flag inside there before it decides whether it's going to break up or whether it's going to break down. Because once they get to a level, they will stack up on their orders. They can't turn price well, they can turn price wherever they want, but they can't get all their orders filled in one particular move. So they are going to flag, either accumulate their orders, or they're going to distribute their orders and then move on. So you can see very clearly that that's there and that that's the nearest place to it. So this is where you would look for a flag to work on. It's all about looking for possible flags in the future. That's all it is. So you look for a bit of empty space. Where is the smallest bit of empty space we've got? That's the first place I'm going to look for exiting on my trade.
So I see a very nice assumption that you look right there for filling between this and this, let's say.
Yeah, absolutely.
If price came to this one, at this line, you look between this and this one, let's say. Price can flag between this and this.
Yeah, indeed. Just look for the smallest bit of empty space you can find, and that's it.
Mm-hmm.
Really simple stuff.
And don't forget,
and that's real bread and butter stuff. Yeah, go on.
You always have kinks level, so when you look at something very in very large scale, you don't see the kink levels, and sometimes the flip will come from there. So
And sometimes the kinks are absolutely tiny. It is
yeah,
wonderful to come to a monthly level kink and it's only 4 or 5 pips wide, because then you can take a stop loss with 5 or 6, or a trade with 5 or 6 pips risk, and you could be making a few thousand on it. And they're just magnificent, and they do happen, and they do happen so often. I mean, do you remember I showed a DAX one? I think it was a daily or a weekly setup or something like that. And there was going to be just the tiniest of stop loss on that. And those are just absolute monster trades, really monster trades. Fabulous, beautiful.
yeah.
Oh,
There are
what's this? The RR is difficult when using the higher time frame as the stop and the lower time frame as target. Well, if you're getting in at the very beginning of a higher time frame kink, and you're trying to take a lower time frame trade using that stop loss, then it's an impossible situation. You just don't do that. If you're at the beginning of a massively higher time frame level and you haven't had PA, then you're just going to have to trade low time frames there. And you can follow a trade and keep it in so long as the PA goes your way. So you can get in at the very beginning of a high time frame setup or a level on low time frame PA, and you can have a very small stop on that. You've got to watch the trade though, because it can easily come right back into deeper into the higher time frame level. So you got to watch your PA. But once all the signs are good to keep staying in, then you are golden for those things. Oh,
Yeah, and
there's
don't
more.
forget, it's a common issue with many that when we say that we work on M15 or M5 or a tick chart, it doesn't mean that we're looking for the formations that we want to work on M5. It means that we are going to time our entry of a higher time frame, let's say H1, H4, daily, monthly, whatever it is, on the M15, M5, M1. Okay, so in that sense, when you time your entry on M1, but the level is a daily level, then your potential, your risk-reward potential is so big, and you actually using the confirmation, using Quasimodo as a confirmation to enter a daily trade. So yes, we're working on an M1, but that's for timing the entry for the daily. Okay, so we're not looking to trade Quasimodos of M1 levels. Okay, so don't get confused about this. The higher the level is the best for us, and it's going to be the most rewarding one. Yeah.
Yes. Was that in answer to the, let me see, to the first Scooby question for intraday scalp trading? I'm having problems finding qualified QMs. Do I really need to pick feed, or do I really need tick feed for those LTF trades? What do you think of that?
Both. Yeah.
Yeah, I thought so. Good.
Yeah, Yusuf, you want to, you can, take the microphone and talk.
Hi guys, it's Gil. I just have a quick question regarding plotting scenarios.
Yeah.
From my understanding, even from the RTM forum originally, I think you wrote originally that the RTM way is reading the market is an exact science. So considering if you have a valid engulf and a target that has not been hit as yet, why would that scenario fail?
It would only fail if you got it wrong, or if there is, as Gil said, some random idiot coming into the market like a bull in a china shop and breaking the whole thing to pieces. There is no
Okay.
reason for it to fail otherwise. But every once in a while, China shops are absolutely lovely places, and everything's so delicate in there, and they're very safe because everything's kept in glass cabinets, and there's a window and a door on the shop, and everything's safe in there. But introduce one random bull running down the street, open up the door, let him in, and he's going to take the whole thing to pieces. And that is why we do not go all in on even the most beautiful trades. It is why we keep our money management tight. And okay, I am always a bit stupid. Well, okay, no. When I trade, I'm very confident in what I do, and I will risk about 5% per trade. I cannot endorse that at all for anybody else. I cannot say, yeah, 5% is it, because that gives you 20 chances to be wrong. Consecutively. I would say 2%, it gives you 50 chances to be wrong consecutively, and it's just much better that way. But I
In
think
fact,
there was kind of another question that you asked in there, or was it just something else that I wanted to say?
yeah,
And now I forgot.
I posted. I've posted to the Skype group 1 2 days ago about a failed engulf on the same chart on this same chart. I don't know if you can see my mouse.
If you
No.
request, you right-click over your name. You can see your name there, can't you? If you right-click over it, then you can request mouse.
You got it.
Okay, okay. I'm looking at this area here. Yeah, right here. Because I didn't take this as an engulf exactly, so
Okay.
I considered all of this still intact, and I seen this point here.
Mm.
It engulfs this small flag limit here by I think less than a pip, but it's still engulfed. Either I checked 2 data feeds, so I had expected that maximum price should come back to here or possibly here
All right.
to try and reach this area here, but obviously that didn't happen. But do you see instances of this happening regularly, or are these very rare?
Well, I think I can take control of this. Now, what you've got here is, I think you're looking at where this compression is over here. I can draw, can I? Yeah.
That's
Where
right.
that compression is there. And then you've got your flag limit up over where there, something like that. I'm not very good at drawing straight lines. Okay, so you say that there is a flag limit there or a kink there where it's broken this. That's fine. So where is the target? Well, look at your compression up over here. Oop. Look at where we broke into the compression on that. We've now gone from taking our targets at the underside of this flag to start looking for targets at the upper side of this flag. So where's the first target in the upper side? It's where we break into this compression here, and we're going to find a kink in there, and maybe that's it. And then if that kink breaks, I would assume that we're going to look in towards the top of this compression over here, maybe at this level here for our next target. That's just a very off-the-cuff target, because there may be something over here which is far more important. There may be an old high or something which is just before it, and they should always take precedence because they can be monsters. So yes, as I say, look for the smallest space you can possibly fill, and there are your targets. So in breaking the kink on this, where's your target? It's breaking the kink on this. You're going from the underside to the overside, and you just find the targets. So it's extremely close there.
Okay, okay, thank you.
Okay. It's always about, as this whole presentation is about, it is about finding those clean orders at important places. And the break into a compression, the kink of that is important. The break out of a compression, well, that's the break of a low, that's important as well, or a high, you know. These are all important places, and if there are clean orders there, you have to respect them, and you have to understand the fact that that could be as far as price is going to go.
Yeah.
Okay, are we down to the, do we factor in the time of day, or is somebody, do we have something before that? Okay. Do we factor in the time of day for entry? Oh, absolutely. For entry, absolutely, yes. Um, once once London has closed and we're in the ending hours of New York, it's not a great time. You don't expect too many people to be making too many big moves in the dead hours unless there's big news coming up and then they're all waiting for it. So if there's not a lot of news coming up, um, why would the big players be interested in mucking around in the market when nobody else is there? They want a lot of people around because they want to fill, if they're going to make a big move, they'll want to fill a lot of orders. I mean, a lot of orders. So if you want to do loads in buying and selling, you need loads of sellers and buyers. And if there are no sellers and buyers around, then there's not a lot you can do. It's like any shop. If there are no customers, then you might as well close the shop. So there have to be both sides of every trade in the market, and if one side just is gone to sleep or whatever, then there's no point in the market being there. So that means that when you're coming up to Frankfurt opening, there's a lot of people in there and a lot of setups happen just on the few minutes after Frankfurt opens. You'll often get great PA set up for them. Then with London opening, there can be great stuff within the first half hour of that. London open or New York open, the same thing. It's when there's a lot of people in the market is when a lot of stuff happens. Then of course you get your tricky people who just want to move price really quickly without filling in too many orders. They can happen at any time where they just dump in an absolute ton of orders, move price, feel great about themselves, and then get out of the market again. Boom. Okay, there's a really long one. Mark, have you got a microphone? Yes, talk to us.
Hi. I was trying to figure out the qualification for this particular trade. If we see there's a move up, okay, but along the way it makes a flag. Now this flag did not get engulfed on the retrace down.
Please request keyboard and mouse.
Okay.
Got it. Let's see.
Hold on. I just go to my name and right click.
Mm-hmm.
Oh, no, you have keyboard access now.
Yeah, you have it. Oh. Now, before you go on with this, I really love this example that Gil found because it is questionable. If Gil had found an absolutely perfect Quasimodo here that has no doubts whatsoever about it, it's like those, have you ever seen people trying to sell indicator systems where all of their charts are this perfect setup was like this and this perfect setup was like that, and we entered here and what you get is price moving for thousands of pips, and look, our indicator system works here because look at this, I've got so many examples of how it's perfect, and it doesn't show you any of the examples where it's just way off the mark. So this for me is questionable. I question this. I see this high over here, and I'd like to draw a straight line on it and maybe wonder, maybe our first bit of PA on this scale is the break of the kink of that high over there. So maybe then we have to break this thing. So is this not a Quasimodo on this scale at all? Or hang on, where was it? I think there, I think it was, is where we started looking at it. So maybe we don't have a Quasimodo at all. So the questionable ones, they are the ones that will ask you the most questions, and questions are, of course, what bring around answers. So for me, this really isn't on this scale a Quasimodo, and that's what makes the example great for me, because it makes you ask many questions, and you're about to bring up some, so go ahead.
That's exactly what I was referring to, because this flag here wasn't broken.
Click on the screen, I think.
Hold on. Yeah, okay.
Yeah, okay.
So I'm referring to this flag here.
Okay.
It wasn't engulfed to
Right.
qualify the trade.
Yeah, indeed. And I see your point, and I think we all do. So then we've got to look at the approach on the retrace and then work it out from there. There's absolutely no point in giving you a dead simple, straightforward, absolutely indisputable Quasimodo on this. So really, I don't have great PA on this at all. Yes, now what we did have is maybe this was the break of something over to the left of an important upper flag limit to the left, and then of course we're into something new. But we do have space down here, we do have these orders down here, and we want to try and get to them. And we've got to reason out how we can get in a trade to get to these prices down here without just blindly entering on the retrace over here and hoping that we're going to fill up this range. Because price, it does range very often. They want to accumulate or they want to distribute, and they can't do it all at one price. They can, as I said, but they won't get their orders filled. So they've got to work within a range to actually get their orders filled. And they don't want to engulf the highs yet, and they don't want to engulf the lows, because those are signals that price is going to move one way or the other. They want to trick as many people into trading in the right direction and then the wrong direction, which means taking stops within this certain range. They've given nothing away yet, so they can fill up tons and tons of orders simply for the move away that they do make when they've made PA.
So does this mean that even though this does not get engulfed, that if we have good PA on the retrace, it can still qualify the trade?
If we have, absolutely it can, absolutely. And as is so often the case, at higher time frame levels, if we are reacting here from a much higher time frame level, then we know that that just this little move down here isn't a very big move at all, and that they're going to try and fill this range again. And fill this range. Anywhere that you've got orders left behind, they're going to try and take them up, get you trading the right side, and then get you trading the wrong side, so that they can either add to their positions and carry on with price, or they can get themselves from net long to net short in this area by mucking around with people's stop losses and getting them very confused altogether, get them revenge trading and impulse trading and doing all that stupid kind of crap simply to take their orders, get themselves net long to net short in these places.
Thank you.
Yay.
You take the correlation into consideration when you try to...
Absolutely you do. Oh, damn straight you do. That's another lesson unto itself, however. I don't think anybody needs classes on correlations, but I might be wrong. Maybe there are classes needed on correlations. They're extremely important. They're a bit obvious. You know, what's obvious to somebody might not be obvious to others. Maybe I should do a course on correlations. It is very, very extremely powerful, but I don't think it's something that really needs to be taught. Tell me later if you want classes on correlations. I'll gladly do them. But it is a big subject in itself. But yes, correlations are another part of it, and they can really add to your confidence. I mean, if two things are very strongly correlated and one has made PA and the other hasn't made PA yet, then you know that the other one is about to make PA. But the market is so well timed, it's so well computerized that PA tends to happen extremely, extremely quickly and synchronized across the entire market. One thing that I noticed yesterday is I was looking at maybe using Bitcoin as a currency, as a currency that I would use, and I saw that I saw on the chart that the futures are at one particular price and that the actual buying price in the shops is much, much lower than that. So that is also another thing. It could be a very good way of actually getting in on a real trade in these things and making up the difference. That's called arbitrage. But arbitrage has a lot to, it's kind of the same concept as correlation anyway. So yes, correlation, brilliant. If you know it, absolutely use it alongside this. It's very simple, like riding a bicycle, I suppose. Yeah, it is. It's very, very simple, very important, but a big subject in itself. Okay, anybody else? Good, I'm bursting to go pee. I think we're done. Yay, excellent.
Okay,
Okay,
guys.
Gil, send us off.
Yeah. Okay. So thank you very much for attending, and let's see how you manage this in your work this week, and we'll see you next Friday.
Yay, same bat time, same bat channel. Yay. See you all
Bye.
later, peeps. Bye.